Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Nebius Group.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And a quick note before we get into today's stock. If you need emergency cash and want to look at a short-term installment loan option, you can check out MaxLend Loans through my link below. Eligible customers may qualify for loan options up to $3,750, and funding may be available quickly if approved. But please be careful. Always read the full loan agreement, APR, fees, repayment schedule, and total cost before signing anything.
So, what if I told you that the absolute biggest bottleneck in the whole artificial intelligence revolution isn't software, it's not algorithms or, even the microchips themselves?
Right, people always jump straight to the chip.
Exactly. But what if the real choke point is actually concrete and cooling fans and just the physical power grid?
Physical reality of it all.
Yeah, because we hear so much about these generative models, right? Shiny new applications interacting directly with users. But there is this massive physical reality to AI that just gets entirely overlooked by a lot of retail investors.
It really does. Software has to actually live somewhere.
Right. And today we're looking at Nebius Group. They operate as a pure play on this exact physical bottleneck. It's all about GPU as a service, which basically means they are renting out the raw physical computing power that makes artificial intelligence possible in the first place.
And I think that's a really crucial distinction to make right at the top. Because like I said, software has to be computed in a physical location. And right now, the entire global technology sector is facing this severe supply and demand imbalance.
Oh, absolutely.
There simply isn't enough high-performance computing power to go around. Everyone wants to run these massive models, and Nebius Group is stepping directly into the middle of that friction.
They're building the facilities for it?
Yeah, hyperscale data centers.
Well, either.
But these aren't your grandfather's data centers. These are specifically designed from the ground up for heavy artificial intelligence workloads. So, we're looking at a hyper-growth infrastructure play that the broader market is watching incredibly closely right now.
All right, let's move into the wealth building context. Because if you're a long-term investor trying to navigate this space, the default instinct is usually to try and pick the winning software company.
Which is incredibly hard to do.
It's nearly impossible. The technology is moving so fast that an application that looks totally revolutionary today, well, it might be completely obsolete in 12 months. It is a highly speculative game to play.
Yeah, you're basically guessing which app goes viral next. Which makes Nebius Group such a fascinating alternative for a structural growth strategy. Instead of placing bets on who creates the best algorithm, you're investing in the foundational infrastructure.
The infrastructure that every single one of those algorithms requires to function.
Exactly. They own the literal data centers.
Yeah.
And the hardware doing the computing.
I like to think about it less like a gold rush and more like the invention of the automobile. Right now, everyone is scrambling to figure out if they should invest in Ford or General Motors, the companies designing the cars.
That's a great way to put it.
But Nebius isn't building a car. They're pouring the concrete for the interstate highway system right as mass production is taking off.
Yeah.
They own the roads, and they're renting out the lanes to everyone else. And in this case, those lanes are the absolute best Nvidia hardware you can get. Owning that foundational layer provides a real structural wealth-building advantage in your portfolio, though, it does require patience.
Right, because laying down concrete and building physical data centers takes time. You can't just push an update over the cloud.
Exactly.
But it's really about capturing that inevitable demand. You're investing in the toll road. And because the demand for that toll road is virtually guaranteed over the next decade by the major tech players, the hyperscalers, it provides a much clearer long-term growth thesis than just trying to pick a software winner.
Now let's look at the fundamentals. And I have to admit, the sheer scale of the numbers we're dealing with here requires some unpacking.
The growth is just wild.
It really is. For fiscal year 2025, Nebius reported revenue of $529.8 million, which is a 479% year-over-year increase.
Almost 500%. That's just massive.
Yeah, but the real story is how they actually finished the year. In the fourth quarter alone, they hit $227.7 million. Meaning they exited 2025 with an annualized recurring revenue, or ARR, of $1.25 billion.
Right, and management's guidance for fiscal year 2026 projects revenue between $3.0 and $3.4 billion.
Tripling it, basically.
Yeah, and looking further out, Wall Street consensus projects a massive catapult to $9.7 billion by 2027.
Which is an eye-watering trajectory.
It is, but top-line growth aside, the margin profile is what really stands out to me.
Yeah.
In that fourth quarter of 2025, they achieved gross margins of approximately 70%.
Okay, let me stop you right there because I'm looking at these 70% margins and quite frankly, it doesn't make sense to me on the surface.
Why is that?
Well, traditional data centers are basically utilities. They provide power, they provide cooling, and they provide space. Utilities do not command 70% margins. What is the actual mechanism allowing them to charge this kind of premium?
Okay, so it comes down to vertical integration. A traditional data center is often asset light. They operate as co-location providers, meaning they basically lease an empty shell of a building, provide basic power, and let other companies bring their own servers.
Right. They're just the landlord.
Exactly. But Nebius owns the facility, and they also procure and own the cutting-edge Nvidia hardware inside it. Because they control that scarce hardware, their average selling prices actually grew 50% sequentially.
Okay, so they own the highly demanded chips, but still, 70%.
Well, the real mechanism protecting that margin is their proprietary software layer. They have platforms like Nebius AI Studio and the Token Factory.
Ah, so they bundle it.
Yes. By bundling the physical hardware with a specialized software ecosystem, they lock customers in. It creates incredibly high switching costs, and that is what defends that 70% gross margin. And, that integration is what allowed them to turn adjusted EBITDA positive in Q4 2025.
Let's clarify that for a second, though. Being adjusted EBITDA positive means that before you factor in the massive accounting write-offs for depreciation and interest on their debt, the core day-to-day operations are actually generating a profit.
Right. The actual business model is profitable.
But that brings me to the balance sheet, which is where my caution flags are waving very aggressively.
I figured you'd bring that up.
I have to. This is a monumentally capital-intensive business. Right now, they are sitting on $3.7 billion in cash, but they have $4.89 billion in total debt.
It's a lot of debt.
It's huge. They just closed a massive $4.34 billion convertible debt funding round. And they needed that because their capital expenditure plan, the money they have to spend just to build these facilities in 2026 is an eye-watering $16 to $20 billion.
Yeah, the CapEx is heavy.
Heavy is an understatement. Their free cash flow is deeply negative. So I have to ask, how can a company burning through cash at this monumental rate be considered fundamentally sound?
Well, that massive capital expenditure is buying them an economic moat that is nearly impossible for new competitors to replicate.
You mean the physical assets?
Exactly. This isn't cash being burned on digital advertising or, user acquisition that might churn. It's being converted into highly sought-after hard assets in a supply-constrained world.
Okay, that's fair.
And more importantly, this aggressive expansion is backed by a $2 billion strategic investment from Nvidia.
Which is a huge vote of confidence.
In today's market, Nvidia is the kingmaker. That financial backing guarantees Nebius gets preferential allocation of the most sought-after hardware on the planet. I'm talking about the H100, the H200, and the B200 clusters.
Oh, they skipped the line?
They completely skipped the line. So the negative cash flow is validated by the fact that Nvidia is actively ensuring their server racks are full. Plus, owning this physical footprint gives them a really unique sovereign AI advantage in Europe.
Right. But we see this massive $16 to $20 billion spending plan, and the market won't truly reward that balance sheet strain until it sees physical proof of execution.
Which takes time.
Exactly. That brings us to the catalyst timeline. The most immediate hurdle is the Q1 2026 earnings report on Wednesday, May 13th, 2026, before the market opens.
That's coming right up.
Yeah, and investors won't just be looking for a revenue beat. They are going to want to see how that $1.25 billion ARR is tracking against the $3 billion target. And they'll want to see how recent acquisitions are blending into the operations.
May 13 is definitely the near-term focal point, absolutely. But looking a little further out to mid-2026, we have a massive physical catalyst. Phase 1 of their Independence, Missouri data center is scheduled to come online.
In Missouri.
Yeah, and this specific facility is rated for 300 to 400 megawatts.
Okay, let's ground that in reality for a second. When we say a 300 to 400 megawatt facility, we are talking about enough electricity to power a medium-sized city, all being routed into a single building just to run and cool server racks.
It's an unbelievable amount of power.
It is. But how does that electricity translate directly into bottom line revenue?
Well, in the GPU as a service industry, power capacity is the exact equivalent of revenue capacity.
Meaning if you don't have the power, you don't have the sales.
Right. Nebius has a staggering $45 billion backlog of hyperscaler demand.
45 billion. That's a massive backlog.
It's huge. These are the tech giants, companies with massive computing needs, just sitting there with contracts signed, waiting. But Nebius cannot recognize a single dollar of that backlog as revenue until the physical servers are plugged in, powered up, and actually processing data.
Ah, so the Missouri facility is the bottleneck release.
Exactly. That 400-megawatt facility in Missouri represents the exact physical trigger needed to take billions of dollars out of the backlog and convert it into recognized revenue. The day they flip the switch in Missouri, the financial profile of the entire company transforms.
Wow. You also brought up sovereign AI earlier, which acts as a major macro tailwind here.
Yeah, it's a huge factor in Europe.
Because the European Union is pushing aggressively for data sovereignty, European governments and financial institutions are becoming extremely wary of processing sensitive national data on servers physically controlled by American tech giants.
They want their data to stay within their borders.
Right. And because Nebius operates major physical hubs in Finland and France, they are perfectly positioned to capture government workloads that are legally bound by strict data residency laws.
Which is great because that's a revenue catalyst completely insulated from normal consumer market cycles.
Absolutely. Now let's pivot to the chart, because the technicals paint a picture of extreme momentum.
Oh, the chart is wild.
We're looking at a stock that has appreciated by 659% over the last 52 weeks.
Just incredible.
It hit an April high of $166.10, and the current 52-week peak sits at $168.71.
The price structure is really fascinating because it's exhibiting classic gap-and-go breakouts.
A gap and go.
Yeah, gap-and-go happens when a stock opens significantly higher than its previous close, creating a literal gap on the price chart. And instead of dipping to fill that empty space, buyers just immediately rush in to push it even higher.
We saw it rip from the 130s straight into the mid-170s this exact way.
Exactly. And when you see technical action establishing a firm series of higher highs without looking back, it tells you the market is entirely focused on pricing in that $45 billion backlog. They are ignoring current trailing earnings entirely.
But see, that unchecked momentum is exactly why we need to issue a practical warning here.
Fair enough.
This is an ultra-high beta stock. The beta is currently sitting at 4.03.
That's extremely high.
It is. For context, if a stock has a beta of 1.0, it generally moves in lockstep with the broader market. A beta of 4.03 means it is violently more volatile. It is heavily influenced by retail sentiment. We're seeing major Wall Street bets momentum driving massive intraday volume, which creates these crazy short squeezes.
Like that day it opened near $160.
Exactly. It opened near $160, dipped, and then aggressively ground all the way up to $176 in a single day. But volatility cuts both ways. A 4.03 beta means it's incredibly prone to sudden, terrifying reversals. In late April, it dropped out of nowhere from $163.67 down to $135.51 before violently snapping back.
Yeah, that was a brutal shakeout.
If you're building a position, you have to be prepared for stomach-churning intraday swings.
So what does market sentiment look like beyond the retail trading?
It's a good question.
From a news and institutional perspective, it is overwhelmingly bullish. The dominant headline recently is Nebius's acquisition of Eigen AI for $643 million.
Right, the Eigen AI deal.
This matters because it pivots Nebius firmly into the AI inference space, integrating it directly into their token factory platform.
Okay, for anyone not deep in the weeds of machine learning, why does a pivot to inference matter so much to Wall Street? What's the big deal?
Well, up until now, the bulk of the artificial intelligence boom has really focused on training models. Training is the process of feeding an algorithm billions of data points so it learns how to understand language or images.
Which takes a lot of raw compute.
Yes, but inference is the execution phase. It's when that fully trained model is actually deployed into the real world, answering customer service questions, generating code, analyzing medical scans.
Oh, so it's the actual product being used.
Exactly. Inference requires different computing optimization and is widely considered the most lucrative, high-margin phase of the entire AI lifecycle.
Because it's continuous.
Right. By buying Eigen AI, Nebius proves they aren't just a training facility. They're positioning for the most profitable phase of the industry. Add to that their new distribution partnership with TD SYN and GEX, which plugs their AI cloud into a massive global sales network, and the institutional narrative really solidifies.
The analyst community is certainly on board. We are seeing aggressive price target revisions across the board. Goldman Sachs raised their target based on a new capacity contract Nebius signed with Meta.
That was a big catalyst.
Huge. D.A. Davidson bumped their price target from $150 up to $200. Wolf Research just initiated coverage, noting that demand from clients like Microsoft and Meta is basically de-risked, and they gave it a fair value range of $80 to $170.
We've even seen independent calls projecting targets as high as $266.
Which is just wild, but it's based purely on the pricing power Nebius holds in a market where nobody else has enough hardware.
What's equally interesting to me is that institutional ownership is still surprisingly low. It's sitting at just 21.9%.
That is really low for a company this size.
It implies massive room for large mutual funds and pensions to accumulate shares as the company actually proves its scale. We're already seeing players like Mitsubishi UFJ buying in with new positions of over 100,000 shares.
Institutional money is waking up to it.
Yeah. And hovering over all of this is a very powerful speculative rumor from the information. They reported that Nebius is actively trying to acquire the Israeli AI startup AI21 Labs.
Oh, wow. If that goes through, that changes things.
Totally. Nebius wouldn't just be hosting other people's models anymore. They would own foundational natural language processing models themselves, moving them from a pure infrastructure provider to a full-stack AI powerhouse.
But we have to look closely at the sentiment data.
Yeah.
Because there is a glaring red flag here.
Let's hear it.
When we look at recent Form 4 filings, which are the mandatory SEC documents executives file when they buy or sell their own company's stock,
Right.
insiders have sold approximately $15 million in shares over the past 3 months.
Oof.
Yeah. Now, to be fair, these sales are executed under prearranged trading plans, known as 10b5-1 plans, so it's not a sudden panic sell.
It's scheduled.
It is scheduled, but when a stock is up 659% and management is taking $15 million off the table, you have to factor that into your expectations. It creates a psychological overhang on the stock.
It definitely does.
Now let's talk about the risks. Because underneath this perfect hyper-growth narrative, there are serious fundamental hurdles.
Of course, it's not all clear skies.
The execution risk alone is monumental. They are attempting to scale their power capacity from 75 megawatts today up to over 1 gigawatt in less than 2 years.
That's a massive operational leap.
The sheer logistics of building infrastructure at that speed, securing the copper, the cooling units, negotiating with regional power grids, it is incredibly difficult to execute perfectly without delays.
Yeah, supply chains are still tough.
But there is an even bigger concern buried in the filings. In their April 30, 2026 20JF filing, Nebius formally disclosed material weaknesses in internal controls over fixed assets and revenue recognition.
Oh, that's not great.
Think about what that actually means. This is a company deploying billions of dollars into physical data center assets, servers, buildings, cooling towers, and they are legally admitting that their internal accounting checks to track and depreciate those physical assets are flawed. How can we fully trust the reported numbers on a balance sheet filled with billions in hardware when the internal controls are weak? It introduces a massive accounting risk and guarantees higher compliance costs until they remediate those issues later this year.
That is a very valid point.
Add to that the dilution risk. We already discussed the $4.89 billion debt load and the $16 to $20 billion CapEx requirement.
It's a heavy burden.
If they hit any construction delays in Missouri or Europe, the revenue timeline gets pushed back, but the cash burn continues. That could force them to return to the capital markets to raise more money, leading to heavy shareholder dilution.
Those are serious fundamental risks, and honestly, the accounting disclosure regarding fixed assets is definitely something that requires close monitoring.
Exactly.
However, the rebuttal to the bear case is that the market has largely priced these risks into the stock's extreme volatility. Wall Street knows building a 1-gigawatt data center network is a logistical nightmare.
They aren't blind to it.
No, they know. But the stock commands this massive premium because the demand side is practically guaranteed. The $2 billion validation from Nvidia, coupled with that $45 billion hyperscaler backlog, effectively de-risks the hardest part of running any business.
Which is finding customers.
Finding customers willing to actually pay you. As long as they get the concrete poured and the servers plugged in, the revenue is contractually waiting for them.
So with everything on the table, what's the final verdict?
Well, the stock earned a bullish score of 8 out of 10.
An 8 out of 10.
Yeah. From a strategic perspective, it really operates on two distinct timelines. In the immediate future, it serves as a highly volatile, momentum-driven swing trade heading into the May 13 earnings report.
Right, playing the catalyst.
Exactly. Any positive surprise on how fast they are converting that ARR could trigger another major upside gap. But structurally, this is a multi-year investment hold. The entire thesis is built on their projected climb towards $7 to $9 billion in annualized recurring revenue by 2026 and 2027. If you can stomach the beta, the upside is tied directly to the physical foundation of the AI revolution.
And I'll leave you with a final thought to mull over. We've talked extensively about how critical Nebius is to the companies waiting in that $45 billion backlog. But what happens to the broader technology sector if Nebius fails to execute this 1 gigawatt scale-up?
That's a scary thought.
It is. If they stumble on the logistics or the accounting, it wouldn't just be a localized failure for their stock. It would expose a massive physical bottleneck that could stall the global timeline for artificial intelligence deployment across the board. The stakes here go far beyond just one company's balance sheet. Need emergency cash. MaxLend Loans offers short-term installment loan options up to $3,750 for eligible customers. Apply through the link below and carefully review the APR, fees, repayment terms, and total cost before accepting any offer.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.